Imagine tapping your credit card to buy some groceries. Now, imagine missing a couple of payments. Today, the worst that happens is your credit score drops. Or you get annoying phone calls from debt collectors. But what if the bank didn't just want your money? What if, to settle the debt, the bank legally took ownership of your house, then your children, then your spouse, and finally, you? Feels like a dark science fiction movie, right? But this isn't fiction at all. This was everyday life 5,000 years ago. Welcome to the ancient world, where the first banks weren't shiny skyscrapers on Wall Street. Believe me or not, they were massive stone temples. And defaulting on a loan didn't mean filing for bankruptcy. It meant putting on chains and becoming a slave to the temple priests. Today, on Uncle Ted Invest, we are going back in time to uncover the shocking, dark, and brutal origins of credit, interest rates, and the ancient financial traps that shape the money we use today. You will never look at a loan the same way again. To understand how this horrible system started, we must travel back to ancient Mesopotamia, modern-day Iraq, around 3000 BC. This is where human civilization invented writing, the wheel, and most importantly for us, the economy. Back then, survival was all about farming. But farming was quite risky. A bad drought or a massive flood might destroy your entire harvest. So, society needed a backup plan. Enter the Ziggurats. These were huge, pyramid-like temples that dominated the cities. Now, you might think temples were just for praying. Nope. Believe it or not, they were actually the very first central banks. The priests who ran these temples didn't just collect prayers. They collected taxes in the form of grain, barley, and silver. Over time, the temple became a massive vault of wealth. And just like modern banks, the priests realized something that changed the history of human civilization completely. Why just let all this grain sit in the storage rooms when we can make it work for us? And boom! The concept of the loan was born. So, how exactly did an ancient loan work? Let's say you are an ancient farmer named Bob. A drought hits, and you don't have enough seed to plant for the next season. If you don't plant, your family starves to death. You have no choice at all. You go to the temple and ask the priests for a loan of barley, simply because you have to. The priests agree, but they charge interest just because to increase their wealth. And we are not talking about current modern 5% or 10% mortgage rate. Oh no. The standard interest rate for a grain loan in the ancient world was a staggering 33.3%. It actually means that 1/3 of your future harvest is simply gone, just to borrow the seeds. If you borrowed silver instead of grain, luckily, the rate was slightly lower, around 20%, because silver doesn't rot or die. Do you have any idea about the purpose of those high interest rates? Well, ancient investing was risky, and there was no insurance. If a swarm of locusts ate your crops, the temple lost its investment. So they priced that massive risk into the interest rate just to compensate this ambiguity. In addition to those, you can imagine that life expectancy of early humans were not as high as today, which also increases the risk of return. But for Farmer Bob, this 33% interest rate was a ticking time bomb. With ancient farming tools and techniques, yielding enough crops to feed your family, pay the king's taxes, and pay back a 33% interest loan was near impossible. If you had just 2 bad harvests in a row, the math became impossible. Compound interest started to wipe out everything that he has. And that's when things got out of control. When an ancient loan was given, it required collateral. Just like how a modern bank holds the title to your car until you pay it off. But Farmer Bob didn't have a car. So, what did he put up for collateral? First, he pledged his farming land. If he defaulted, the temple took his field. But without a field, how do you pay the remaining debt? You can't. So, the collateral escalated. Next, Bob had to pledge his servants, if he had any. When they were taken, he pledged his children, then his wife. Yes, you heard that right. Ancient laws allowed creditors to legally take a debtor's family members as laborers to work off the debt. And if that still wasn't enough to cover the massive, compounding 33% interest, Bob had to pledge the only thing he had left, his own body. Farmer Bob would be stripped of his land and forced to work the temple's fields as a debt slave. He wasn't a prisoner of war. He was a citizen who simply couldn't beat the math. Over the centuries, this vicious cycle meant that a huge percentage of the population lost their freedom and became permanent servants to the wealthy elite and the temples. The economy was eating its own people. The rich were getting incredibly rich, and the poor were literally becoming slaves. But this created a massive problem for the guy at the very top, the king. You see, a king needs two things to stay in power: an army to fight and taxpayers to fund the empire. But slaves don't pay taxes, and slaves don't fight in the military. As more and more free citizens fell into debt slavery, the kingdom's military and economic power started to collapse. So, ancient kings did something that would make modern bankers completely lose their minds. They invented the Clean Slate. When a new king took the throne, or when the economy was about to collapse, he would issue a royal decree. In Sumerian, it was called a margi, which literally translates to return to the mother, meaning a return to a natural, free state. With one royal command, the king would cancel all consumer and agricultural debt in the whole empire. Boom. Gone. If you lost your land to the temple, you immediately got it back. If you or your family were enslaved for debt, you were instantly freed. The clay tablets recording the debts were physically smashed into pieces in the public squares. It was the ultimate economic reset button. Famous rulers, like Hammurabi, codified these debt forgiveness laws to prevent the elite from permanently enslaving the population. It was the only way to keep society functioning. We've come a long way since the days of ziggurats and clay tablets. Today, we have bankruptcy laws to protect us from literally becoming slaves if our businesses fail or we can't pay our credit cards. But the core mechanism invented 5,000 years ago, the power of compound interest, the risk of leverage, and the sheer wealth generated by lending money, still drives the global economy today. The tools have changed from barley to Bitcoin, from clay tablets to digital apps, but human psychology around debt hasn't changed at all. So the next time you look at a loan agreement, remember poor Farmer Bob and make sure the math works in your favor, not the bank's.